morning and welcome to the Ellsworth Advisors September monthly update. I'm Kelly Keenan. This is Cameron Mealy, my partner, and today we're going to basically share with you what's happened through the month of September, give you an economic update, talk about our portfolios, how they performed, how some of the positions performed, and then also what our outlook is over the next couple months. Cameron, I'll let you kick it off, a little economic update.
Thank you, Kelly. So if we look at the economy, obviously the broadest measure of the economy is gross domestic product. Revised numbers now for the first and second quarter, not final numbers, but first quarter GDP was down 5% on an annualized basis. Second quarter GDP was down 31.7% on a revised basis, again annually. Now, what's interesting about this is the third quarter estimate, and this is according to the Atlanta Fed's GDP Now model, is a positive 32% annualized increase in GDP. So obviously, first quarter, we were just starting to get a slowdown with COVID in kind of the February, March timeframe. Second quarter, obviously, we almost came to a dead stop in the economy. And now we're really seeing what a lot of people call a dead cat bounce. We got to such lows that anything is an improvement. So third quarter, looking for a really strong quarter in terms of GDP growth off of a very low quarter. But what's interesting is while GDP is expected to increase significantly, earnings for the S&P 500 are expected to be down. So this is from FactSet, who's a research group, and I'm going to read it. For the third quarter of 2020, the estimated earnings decline for the S&P 500 is 22.2%. If 22.2% is the actual decline for the quarter, it will mark the second largest year-over-year decline in earnings reported by the index since the second quarter of 2009, which was down 26.9% financial crisis. So what's interesting is we have GDP up, earnings are going to come in a little bit weaker, yet valuations remain strong. Right. So valuations. The forward 12-month price-earnings ratio for the S&P 500 is currently 21.7. This PE ratio is above the 5-year average of 17.1 and above the 10-year average of 15.4. So, what that tells me is there's a lot of money out there. Try to chase investments, and there's a real resiliency to the U.S. economy. We've seen this before where the economy has been beaten up but comes back very quickly. Let's talk about employment. This comes from the Bureau of Labor Statistics. So we saw non-farm payrolls were up 1.4 million in August, and the unemployment rate dropped to 8.4%. So throughout this COVID pandemic, we saw unemployment reach mid-teens, and now we've seen it come back down to 8.4%. Again, strong showing by the U.S. economy, strong resiliency. Employment figures today, the jobs report that just came out, 660,000 new jobs added.
Yeah, the expected was what, 8 something?
I think 850 was the expected.
Okay, so not quite as strong as expected.
Not quite as strong as expected, but still we're adding jobs. So where do we go from here? The biggest issue I think right now that the economy is looking for is stimulus. We know that we've got a presidential election coming up. We know it's going to be a very contentious election. We know it could be a contested election. We might not have a president until January or February. We've got a Supreme Court fight. We've got earnings. We've got progress on COVID. But I think really the issue today is stimulus. Obviously, the House Democrats passed a $2.2 trillion stimulus package. Donald Trump has said he's in favor of a $1.5 trillion spending package. Senate Republicans have said they really would like to keep the stimulus around $1 trillion. Regardless, I think everybody recognizes that both sides of the aisle have to come together. They have to put a plan into place. They need to get money out to the consumer, and they need to do it quickly. So
exactly.
There's a lot of posturing going on.
Yeah, there's been a lot of polarization. We need to compromise. I can't believe that they won't come together in some shape or form. That's going to be, between, call it $2 trillion in stimulus, which will probably be happening.
Especially when you see the airlines, about to announce 50,000 layoffs.
Right.
No one wants to see that.
Exactly.
Everybody recognizes that a stimulus package has got to include a bailout for the airlines, and it's got to happen. It's got to happen quickly.
Right.
So my question is then on what are we going to see in the fourth quarter? So I've seen estimates of fourth quarter GDP growth from approximately 1% growth to 7% growth. Mm-hmm. Those forecasts have come down when it looked like stimulus wasn't going to happen. They've come back up. Now that stimulus does look like it's going to happen. But my expectation is I think we might see some upside. in the fourth quarter?
I think there's upside. I think one of the biggest issues, the stimulus package, yes, that's an issue. I think something's going to get put through. There'll be some stimulus out there. But just with the natural progression, and where I see the biggest issue is not so much the election. The election is going to be what it's going to be in the long run. Study has shown it doesn't matter if it's a Democrat, Republican. Not a whole lot's going to change from that standpoint. It's not going to have major effects on the economy. But the true driver of all this is, even the fiscal stimulus, that's all about the COVID and what's going on with the pandemic. And what we do know is, we've had a fall off in cases. They're starting to pick up. We're going into flu season. That's natural. Mm-hmm. But the other side of it is how we're treating it, whether it's the various different medications.
Treatment options have gotten so much
better. In different
better.
situations, there's no one magic bullet that addresses the disease in different people, but there's a multitude of different drugs that work in different cases. So, okay, now there's ways to treat it. And then, the whole vaccine thing, we're moving down the path with multiple companies that have multiple vaccine solutions coming down the pipe that are far along in trials. As those start to be rolled out, obviously they're going to hit the most at-risk parts of the population first. And then people that are the most fearful, the vaccines are going to help kind of ease their minds, and you're going to see the parts of the economy that have been most impacted.
People feeling more comfortable traveling, getting on planes, going to restaurants.
All that stuff. I think we continue to see that trend up. Now, there's going to be bumps along the way. Air travel was ramping up. It's pulled back a little bit more recently, but I think ultimately the trend is up with, you're going to have 2 steps forward, 1 step back, but the overall trend is positive. So if the estimates are 1 to 7% GDP growth in the fourth quarter, I would say, okay, it's probably better than 1, maybe not as high as 7, but I don't, God knows they come out of vaccine in 2 months from now, you could see it better than 7. I think it's going to be positive growth.
And I think one of the wild cards in this too, and obviously I'm not second guessing these economists, this is what they do for a living, but we've talked about over the last couple of months the amount of savings.
Right.
Stimulus checks, savings, people not going on vacations, not going to dinner, not going to the movies, not spending money. I think we could see a huge retail holiday season. Because I can see families saying, we didn't get to have vacation this year. Let's blow it out. Let's have a great Christmas. Let's spoil the kids. So you could see, I'm sure we're going to see a record online sales.
Putting that into context, you're looking at where's the money's not going to be spent in the areas that have already been beaten down. We're talking about our investments. We don't have money in airlines. We don't have money in hotels. We don't have money.
The winners are going to keep on winning because of this.
So, okay, but where's the money going to go? Nike, Apple, things that, are the companies that have survived. That's probably going to only push money more towards them. So, and it also, there's more savings out there. When you look at where do you put that savings, put in the bank, earn nothing, 0.01%, put in short-term bonds,
earn nothing.
0.2%, 0.3%, or, where can you get, a 2-3% dividend yield? Okay, that's the market. So it's kind of, there is no alternative. That, if anything, will continue to push money towards the market.
Yeah, and support the equities.
Cameron mentioned valuations. There's a portion of the market that is getting very richly valued. It's a handful of stocks that have driven the S&P 500. Those valuations scare me. We do have exposure to a couple companies like that, say Apple and NVIDIA. We cut back on exposure, back in August a little bit on those. But for the most part, we're sitting on more stocks that have a little more reasonable valuations. We're trying to stay away from that big downside risk of those overvalued stocks. And when you look at the S&P 500, which year to date, the S&P is up just over 4% year to date. Last month it was down 3.92 because, in the S&P 500, if you took away the 6 biggest stocks that comprise about 30% of the index, the S&P is still down 3 to 4%, which, talking about GDP numbers, with all that up and down, estimates have been that when we look at the year over year, 20 versus 19, the estimate's going to be around the economy probably will have shrunk 4 to 5%. Okay, the market is kind of in line with where the economy is.
Yeah.
So if we're kind of avoiding those really expensive stocks, as the economy continues to improve, we should be able, for the most part, when valuation ultimately matters, we should be able to dodge the long-term effects of that, that reconciliation.
The market is
which
efficient.
Who knows when it's going to happen.
Yeah.
So let's talk about the market a little bit. So year to date, like I said, the S&P up 4.09%, but for September, the S&P was down 3.92%. In September, the Dow was down 2.28, so you kind of see that divergence where the Dow didn't get hit as hard as the S&P. That's because of the makeup and the weightings in those two indexes. Dow's not as heavy in those six stocks they're driving things. Year to date, the Dow is still down 2.65% versus the S&P up a little bit over 4%. The NASDAQ, which really reflects where those stocks lie, or they have a really heavy weight in NASDAQ, year to date up 24%. But in September, it did pull back 5%. Now, last couple of days, we've seen a little bit of firming up, but I get the sense we may see that trend continue. We did see small caps do well in September. The Russell 2000 was up 3.47, but as a whole, that whole index is still down 9%. On the international front, developed world, the EAFE down 8.92% year to date. For the month, down 2.86%. Emerging markets, year to date, down 2.91%. For the month, down 1.77%. So that's kind of where the markets are. In our portfolios, growth with income portfolio, our balanced portfolio, last month, down 1.7%. So actually did better than the S&P and the Dow. Year to date, we're still up around 7%. So that's held up really well. And the big gainers in there for the year, Apple's up 58.84, Nike's up, just under 25%, 24.84. Nvidia, a big one of ours, up 130%. Gold up 24%. Visa up 7%. So, big gainers in that portfolio. Obviously, part of them are driven on the tech side. Fortunately, we have gold in there to help balance that off. We have some, non-stock assets in there. Big losers year to date. CVS is down 19%. Our commodity fund is down 10. Cisco is still down about 15.87. For the month, so in September, Nike had a good month, up 12.2%. So when tech's getting beat up, Nike actually started chugging along. We just bought Lennar maybe a couple weeks ago. That's up 7.8%. Really definitely seeing a surge in housing. So I think that was a fairly timely buy there. Starbucks up just under 2%. So that was, a good month there for, those three stocks. For the month, our losers, CVS gave up 6%. Gold was actually down 4.79% for the month. Disney got hit, down 5.91%. And Apple gave up 10% last month. So, they're still positive for the year, but, we saw some rotation last month. Dividend yield, last month up 0.77. So actually, we made money in dividend stocks last month. Year to date, we're still behind the bogey. We're still down about 3.25, 3.2, 3.25 on dividend yield. Last month, some of our good gainers, Con Ed, British American Tobacco, LyondellBasell, which was a drag on us in the fall. We're starting to see that pick up. Caterpillar up 4.81%. Our losers last month, Prudential down 6%. Kimberly-Clark down about 5.75%. And Alliant Energy down about 4%. Year to date, still our big gainers in there. UPS is up 46%. McDonald's is hung in there. It's up 13% for the year. Eaton up 10%. Kimberly-Clark up just under 10%. So, we're seeing some industrial starting to move. So the tech's kind of sliding a little bit. Well, but in that portfolio is more industrial-oriented dividend.
And you look at something like Caterpillar. There's been a lot of talk about infrastructure spending over the last couple of weeks. And obviously, we all know big yellow Caterpillar. And if there's infrastructure spending, there's going to be a lot of equipment out there.
Definitely. Price potential, still struggling there. We're down 2.12 for the month, so kind of between the Dow. Well, actually, better than the Dow and the S&P for the month. Starting to pick up a little speed there. For the month, Comcast up 3.25. I think they should participate in the whole election stuff, I would think, just for the media side. Allstate up 1.23. Costco 2.1. So really nothing that was really strong, nice little gainers, but nothing major in there. Where we saw some pullback, Northrop Grumman down 7.92, Edwards Life Science down 7, Genpact down 7.42. year to date, our big gainers in there: Costco up 26%, Kimberly-Clark up just under 10. Two of our bigger gainers there. Small caps last month up 1.1%. We're positive. We're up 1% for the year. So, lagged the index the month, but year to date we're well ahead of the Russell 2000, which is down 9. We're actually up 1%. So that was solid. For the month, it's always fun looking at these stocks. Gainers for the month: Novacure up 34%, Fulgen up 35.45, Zynex up 18%. So that's the good. The other side of that coin, actually, I'm on the loser side. LifeVantage down 19, Emergent Biosystems down 9, Protolabs down 11. So obviously our gainers were a lot bigger than our losers. So a pretty good month in small caps, and kind of where things are going. I like the small cap space right now. I think we have good opportunity there, and I can expect some advancement going into the end of the year with the small cap portfolio. So in general, we're sticking with the strategies. I think our eye towards quality is going to start paying off here as we go into the fall. Short term, obviously, we're going to have the headline media volatility with the election. A big risk is, okay, if the election's contested, that will cause the market to be really volatile.
The market doesn't like uncertainty.
But it'll die. The volatility will die down as we go through that phase. Like I said, I think the biggest key is the track of the COVID and where that goes.
If you remember
the end of the year,
if you remember Bush Gore, the market got slammed, and it came back within a couple of months.
Yeah, well, I read, and that's the thing, the volatility indicator. By the time they ruled, hey, election is done, decision made, volatility just basically kept on creeping down throughout the whole process, and by the time the decision was made, it was right back to where it started before the election.
At the end of the day, we are the largest economy, the largest, the driver of the world economy, and
Absolutely.
We've had peaceful transitions of power for the last, couple hundred years, and that will continue.
No, I think we're, the key is the direction. We're moving in the right direction. I don't think there's going to be another shutdown. And that's in nobody's interest at this point in time.
Yep. So expect a little volatility, but know that we're focused on quality, thinking about the long term. And if you have any questions, please feel free to give us a call. Have a great day. Have a great month. We'll talk to you next month.
Thank you.